In the world that businesses operate in, one good thing is there is an abundance of information that floats around in virtual space on the internet. One bad thing about the modern world that businesses operate is that there's a lot of information floating around in the virtual space of the internet, and unfortunately a great deal of that information is hogwash and not really worth the paper it's printed on in terms of virtual space. One aspect that I want to focus on today is the discussion and the proselytizing about debt and why business owners should go out there, leverage and borrow as much money as possible, and that's how they're going to become super rich. In this week's I Hate Numbers video, I'm going to go through the pros and cons of borrowing money, flag up some warning signals here, and ask you to treat debt with some element of caution, albeit if you do it correctly, it's a great way to power your business. Hi folks, my name is Mahmood. I'm a business finance coach, accountant, tax advisor, and author of the book I Hate Numbers, and owner of the firm of that same name. For over 28 plus years, I've been helping business owners like yourself make more money, increase their financial literacy, increase financial understanding, reduce stress, reduce tax liabilities, save time, and who wouldn't want that for their business? And I want that for you. Let's crack on with this week's video. Now, the whole subject about debt is effectively where you, as a business owner, owe money to a third party. So you might borrow that money from banks, you might borrow that from financial institutions, and in some quarters, no names mentioned, it's seen as the only way that you should operate your business. People talk about debt being tax deductible, and it is to some extent, but it's not quite as straightforward as people make it out to be, and there are some inherent dangers with borrowing money. Now, first of all, let's compare and contrast the options. You either go out there and borrow money, you borrow money for the short-term fluctuations in your business cycle, what we might call for working capital, or you borrow money to buy assets, major assets like equipment, plant, other businesses, property perhaps, and that asset purchase is made by debt, by borrowing. Now, let's talk about the tax deductibility, which is always waved around as one of the incredible things why debt is so much an advantage, and how rich people, rich organisations go out and borrow money and don't use their own cash reserves. Now, the tax deductibility, certainly as far as the UK is concerned, is not actually in the actual amounts you repay back to the lender, but on the interest costs that are paid over. So if I take out a loan, I will repay back to the borrower one of two things. I will either repay back the initial sum that I borrowed, which is called the capital or principal sum, and then on top of that, I will pay the interest on that loan. The rate of interest is very much dependent on my business circumstances, the level of risk the lender perceives they're going to make. More of that in a few moments. Now, if I've got a loan repayment that's going back on a monthly basis, then effectively within that, there will be an interest component typically. The interest is tax deductible. The amount that I've actually got to pay back on the initial capital sum is not tax deductible, therefore that's largely ignored. The second thing is, as far as any cost of arranging that finance, in general terms, that is tax deductible. Now, let's not tax dictate the actual business decision making, because if you're paying tax at 20-25%, you're still going to pay out, for example, $100 worth of interest. You save tax at most at 25%. If we're talking UK tax terms. The principles apply to wherever you are in the world, by the way. So, but again, just take into account your own personal tax rates that apply. Now, another advantage of debt over raising the money yourself through funding, through shares, your own funding, is it's relatively, and I say relatively very loosely, quick to arrange. You don't have significant costs of arranging that finance, and it's quite quick and it's quite straightforward. Certainly, compared to raising money through equity, it's a much shorter time cycle involved. The third thing is debt can be, if used correctly, a very powerful way to invest currently now for those benefits that will come some way down the track. In my own business for 28 years, I've been in situations where I've actually gone out to borrow money. That's been a big plus point for me. But also, let's now think about some of the drawbacks to borrowing. The thing about borrowing money is that you have a commitment now to the lender. you have to pay back typically a fixed monthly amount here, and that represents what's called a fixed cost. Now, if your income stream, your profitability is quite low, and you've got a commitment to service that debt, then the level of operational or cost gearing that you've got is quite significant, and it can be quite dangerous. If your profits are relatively small and static, and you can't service the debt maintenance here, then you run the risk of effectively your business going into liquidation, your business hitting the brick wall, and the lender wanting their money back, and they will pursue you accordingly. The other danger, if you can call it that, with borrowing too much money, is that the risk to any potential investor goes up dramatically. Investors will typically be paid last, and therefore they may perceive that as too expensive. Now, one of the other plus points of borrowing money is because typically it's not your personal funds that you're investing, and if it all goes belly up, it's the company that is personally liable for that debt, not you as an individual. Obviously, things like bank overdrafts, certain types of loans, the lender may want you to put some security against that, and therefore your personal assets may be at jeopardy. Other things to consider when you're going out to borrow money. The interest that's charged by the lender represents their profit, and that profit they are going to make from you is dependent on how much risk they are perceiving to take. So if they're lending money on an unsecured basis, i.e. no assets are offered, the rates will be much higher. If they perceive it's a new startup business, if they perceive that you as an individual don't have much business credibility, then the interest rates will go up as well. So even though it might seem very attractive, you could be leading yourself into some dangerous, choppy water, especially that if you're not able to service that debt, especially if that interest cost is quite high. And remember, debt is payable irrespective of whether you make profits or not. And that early stage of a business cycle or a new development, a new pivot, a new product development, a new rollout, your cash inflows are going to be quite modest and quite low, and the cash outflows could be quite significant. Debt represents that additional burden on top of it. So let's summarize what we've got, folks. Borrowing can be a good thing. There is a cost attached to it, the cost of arranging it, the cost of servicing the debt, and again, that could be potentially quite prohibitive in the early stages. The plus points are that you as an individual may not be liable for that borrowing. It's your company that's liable, and therefore, if it all goes belly up, the company itself, if it has no assets, is liable for that debt, and it sinks there. You may also take down with you some suppliers and creditors, but that's again something you need to factor in, and it's not a particularly ethical way to run your business, but it does happen. Now folks, as a Brucey bonus here, there's a few things I would add to reinforce if you're going out to borrow money. Make sure you've got a robust cash flow, and that cash flow can either be manually done, or check the show notes here for a link to our Numbers Know-How platform where you can actually plan those eventualities. And if you've got a control on that debt, if you've got an understanding of what that cash flow looks like, you're going to be on top of it. It's going to be a definite plus point for you as well. If you want to work out what your risk is by borrowing large amounts of money or small amounts of money, we've got a loan calculator on the website, as well as a calculator that works out the level of operational risk that you have. Whatever your decision, think about it carefully, but do not get sucked into that idea that borrowing per se is always a magnificent thing to do. It's not. It's fraught with danger, fraught with difficulty, and you've got to really think about it carefully. However, it can be a very powerful force for the good of your business. I hope you found this useful. I'd love it. Give me some feedback here and share it with those who you feel will benefit. And folks, until we speak next time, I'll see you on the other side.